Well, good afternoon. Happy Friday, February 20th. Let's get right to it. A lot to talk about. So, first things first, January existing home sales really disappointed. In fact, January existing home sales coming in at a multi year low. Since home sales dropped 8.4% last month to a seasonally adjusted average rate, our annual rate of 3.91 million units. Listen, anytime we get below an adjusted annual rate of 4 million units, that's recession territory. So continuing the trend for existing home sales and new home sales too, quite frankly, with some low levels here. Now, a lot of people are going to blame this on a variety of things, whether that's affordability, maybe it's a buyer strike, as they say, or maybe it's not quite enough inventory. But you have to throw weather in there as a factor as well, particularly on the East Coast where we saw two storms back to back in January, both of them on the weekend. So ultimately, what we saw there was a tepid demand on the east. But if you go out and look at the West Coast, the change in existing home sales actually increased. You see California out there through Nevada is up about 4.7%. And then we go up here into the Mountain West. You see they're up about 10.5%. Down here through the Southwest, Texas, 1% increase. And then we come over to the East Coast, and obviously this is where a lot of the population in the United States lives. And we saw these declines going back to so far from 2026 back to 2025, where we've got some of these declining existing home sales, and that's skewing the numbers just because of the quantity of people that are there. So this is going to be something interesting to watch, particularly as we move towards better weather. Will we start to see improvement in those existing home sales? We can only hope so. We know what happened today with the Supreme Court ruling on President Trump's tariffs. They've ruled the tariffs unconstitutional, but leaving the conversation about refunding the tariff money that's already been collected to the lower courts. The Supreme Court really did not address this, and we can thank them for that, because the bond market certainly wouldn't have liked it if they had ordered the tariffs to be refunded. The country obviously runs a deficit. When you don't collect enough tax revenue, your only other option to fund your spending is by auctioning off treasuries and other debt instruments. And ultimately, that puts upward pressure on interest rates. So the fact that the Supreme Court is leaving that up to the lower courts is going to be interesting, and I think sets up for a pretty lengthy legal battle. That will be interesting to watch. Thus far, mortgage-backed securities taking the news in stride. Listen, this was not all that unexpected. The betting markets, whether that's the Poly market or Kalshi, have been pricing in that the president was likely to lose this battle, and indeed he did. So they're running a huge upset in the marketplace, and the fact that we're not necessarily getting to having to repay the tariffs has given bonds a little bit of a break, and we'll take every bit of that we can get. Also coming in today was personal consumption expenditures. Listen, personal consumption expenditures actually ticked up and beat expectations. We were really hoping to build off of the consumer price index and see inflation come in lower than expectations, getting down close perhaps to the Fed's target rate of 2%. That just flatly didn't happen, with the overall year-over-year index now for PCE at 2.9%. And if you strip out food and energy, we're at 3% inflation, just higher than what I know the Federal Reserve would like. But there's an important distinction to make here, and I'm going to flip the screen around and show it to you. So this red line is CPI. That's Consumer Price Index. This is probably the most widely recognized measure of inflation. The green line is really what the Federal Reserve watches. That's PCE, or personal consumption expenditures. And typically PCE runs a little lower than CPI. Not always, but for the most part, it typically runs maybe a quarter to a half point lower than CPI. Only 5 times, 5 months in the past 5 years has PCE been higher than CPI, and we just had it. So PCE coming in higher in December versus where CPI was in December. We've already gotten CPI for January, so we'll wait on PCE for January, see if this trend continues. So this is unusual, not unprecedented, but it is unusual, these 5 times that we've seen in the past 5 years, for personal consumption expenditures to actually be higher than Consumer Price Index. That's not normal, but we certainly have seen that in the offing. But all in all, we can be pretty thankful that we're seeing mortgage-backed securities hold ground. We have not given up a lot today, and there's been plenty of reason that we should have given up a lot. But between the ruling on the tariffs and PCE coming in hotter than expectations, we would have expected mortgage-backed securities to sell off and mortgage pricing to worsen. That simply did not happen. A lot of it because the tariffs were expected, but it's nice to see the market shrug off PCE. My hunch here is that PCE is now reporting for December. That's kind of a long time ago. We're 45 days in the rearview mirror. And I think looking out into the future, particularly with questions around the labor market, perhaps traders are taking a measured approach versus being super reactive to that PCE number. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com.